The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
Welcome to the Ascent. This is Sam McGee, CEO and owner of Crestmont Private Wealth. We have offices in Boerne and Houston, Texas. You can reach us at crestmontpw.com or email us at info@crestmontpw.com. And today, we're going to be talking a little bit about the fixed income market or bonds. The equity market gets a lot of the headlines, and we believe that there is a significant opportunity within the fixed income and bond market if you're an investor that has allocation to bonds to get some different and diversified exposures in your portfolio. Consult your advisor for any investment advice surrounding your holdings. But I'm going to give you a bit of a framework of why we believe that there is really good opportunity in the fixed income market and give a broad stroke education on the topic. I'm recording this in January 2025. This is post-inauguration, and just a few anecdotal points about fixed income and bonds. Before we get started, what is a bond? Well, if you want to know, you can go back to a previous show. It is essentially a debt instrument from a company which you can invest in. In other words, you are on the receiving income or coupon payments and then par in the original bond value at maturity. And there's all sorts of ways to invest in bonds through mutual funds and ETFs or exchange-traded funds, just lots of ways to do it. But what we've seen over the past few years is the rise of exchange-traded funds for fixed income in the bond market, whereas in the past, a lot of times you had to go out and buy individual bonds, or the only real alternative was through mutual funds. So there's some advantages to that, which we could discuss one-on-one, some pros, some cons, and that's obviously a more individual conversation. We're going to talk a little bit about the cyclical outlook for the fixed income market. So first off, one observation is that when inflation goes below 3%, the bonds to equities correlation is typically negative versus zero or positive. Now, if I've lost you, this in summary means this is a good thing for diversification when inflation goes below 3%. So as the Fed targets a 3% or lower inflation rate, we believe that bonds will do a really good job of diversifying against stocks or equities in your portfolio. We believe that is a good thing. Historically, that's what we have seen, which does not mean that is future results. For the year, we are looking at roughly a 2% real GDP forecast for 2025. That is what we believe at Crestmont Private Wealth. And that's roughly a 4.5% nominal, still slowed growth GDP rate. And really, we're looking at a lot of changes this year, and that's because the U.S. policy has pivoted quite a bit, which has created a lot of uncertainty. That's created uncertainty in the bond market as well as the equity market. We've seen talk on tariffs, stance on immigration, stance on geopolitical issues, and we have a Fed that has been cutting rates, still has room to cut rates, but might be at a slower pace. So that's created a little bit of intrepidation within the market, and we believe opportunity as well, which we will get to. The labor market has been cooling. We do believe we're in the 8th inning of the policy perspective on inflation reduction measures. And ultimately, we do believe that inflation will settle somewhere around 2.5% to 3% by the end of the year. But tariffs have the potential to really amplify and dampen the growth and inflation. It's not a one-sided risk, and it really remains unclear what tariffs or threat of tariffs could play with inflation. So be careful about what you read. It's not one-sided. It's a double-edged risk, and it just kind of remains to be seen. But it has definitely created some uncertainty. And there's even an index out there called the Trade Policy Uncertainty Index, which spiked recently to a near all-time high, which I think is really interesting because that's not even something that I follow that much, and it just popped up in the news recently, and well, there it is. The U.S. balance sheet continues to be a long-term risk, we believe, the debt in aggregate, meaning that after COVID, there was just a massive amount of stimulus, and it's a lot of debt, right? But if you think about the U.S. and you think about the U.S. relative to other economies, other countries, other currencies, the U.S. still is, in our fundamental belief, the cleanest shirt in a dirty pile of laundry. Most countries have shifted towards a policy of stimulus when there are downturns. And so it's become pretty commonplace for countries to be carrying more debt relative to GDP. So it's just a little bit of a new normal, not necessarily something that we're incredibly comfortable with. And we do think that that is a long-term risk. That is a tail risk, and it's creating also a bit of opportunity and uncertainty in the fixed income market. So why am I talking about the economy as it relates to fixed income or bonds? I just gave a whole bunch of information there, a whole lot of opinion as well, and it's ultimately two topics that really drive bonds: interest rates and credit risk. So credit risk is more related to the global or country or company-specific economic environment. How is that company doing for that bond? How is that country doing? How is the global economy doing? That's credit risk. And then you have interest rate risk, which is more, hey, what is the Fed doing on the short-term rates? What is happening with the 10-year rate, which is more driven by the market, or even 30-year rates, mortgage rates, so forth. Interest rates and credit risk are two areas that really drive a lot of the volatility in bonds, in the bond market, and also drives the opportunity. And what we've been seeing is that the beginning of this year, in 2025, has probably been one of the most swift changes from a policy perspective, and we're talking about Washington having control of all three branches. So that's a pretty big deal. Now, there are certain things that can be done by executive order, and there are certain things that are going to require Congress. So everything you read, take with a grain of salt, because at the end of the day, there is limited power within the executive branch for a reason. I mean, that's constitutional. So be careful about what you read and what you expect to happen as a result of policy in markets. From a policy perspective, a lot of headlines are surrounding Trump and what is going to happen. There's obviously a lot of rhetoric, a lot of talk on tariffs and deportation. And no matter how you vote, no matter what your political ideology is, I think it's really important to remember that what is in print and what actually happens typically are two different things. And there's not going to be a 1 + 1 = 2 for every headline that happens. It's just not going to work that way. Some of these things that are in the agenda are going to happen, and some are not. And the impact in markets remains to be seen. Tariffs, really, we have to look at back to the 1930s. Tariffs, gosh, I mean, they were enormous back then, and they've gone from a scale of 20% rate down to 2% rate on imported goods. Why do I say that? People forget it. People forget that tariffs have been a part of policy in the past, and sometimes it's failed and sometimes it has worked. And it is a different environment today. Now, on deportation and as it relates to immigration, I'm not going to touch on the political side of that, but what I will say is that the executive actions and orders on the border are probably going to be on stopping the flow. Believe it or not, the flow of migrants started actually in Trump's first administration and then really spiked during Biden. I saw a slide recently that the net inflow of migrants across the border during Biden's administration was 7 million. an absolutely enormous number. And so I do expect that Trump is going to have those executive actions that will take place to curb that net flow. Whether there's a mass deportation or not remains to be seen. The next piece is deregulation. We do think deregulation is likely, but it's going to take time. This doesn't happen overnight. And deregulation doesn't mean that entire industries are going to get obliterated or there's going to be no rules and it's the Wild West. It's really about taking out some of the red tape that may be involved or the inefficiencies involving different departments of government and perhaps a more business-friendly climate. Now, one other piece that is important to note is we talk about this majority of power, so having all three branches, but the House majority is only 2 seats, not as many as some previous administrations. So that's actually pretty narrow. In our estimation, a lot of the policy that is going to be coming down the pike really needs to happen in the next 2 years. And that, we do believe, is going to create quite a bit of opportunity and uncertainty in the fixed income and equity market, because anytime there's a regime change, there is going to be, in our estimation, volatility, which can also create opportunity. This is just a little bit about what's happening in Washington, what's happening in the fixed income market. It's a very, very long, wide subject, and we love talking about it. At Crestmont Private Wealth, we are a wealth advisor fiduciary firm, and we work with high net worth families, typically with $500,000 in assets up to about $20 million in liquid assets. You can reach us at crestmontpw.com. If you'd like to have a conversation with us, there's a contact tab there. Today, we're talking about fixed income, bonds, the start of 2025, and some of the things that we're seeing right now. We're talking a little bit about some long-term risks, being the U.S. balance sheet, having a lot of debt. We're talking about higher yields that are a part of a rate cycle where the Fed had raised rates and now they've cut them down to a more appropriate level. We were also in an inflationary environment. So that also plays a part in fixed income and bonds. Now, what does this all mean for you? If you're listening to this and you're not an advisor, this may sound complete Greek. Now, here's the takeaway. The takeaway is that wealth managers, fiduciary wealth managers, pay attention to this stuff. They pay attention to the bond market, otherwise known as the fixed income market. And they look at that through a lens as a fiduciary to understand your individual situation and then apply whatever standards or parameters are needed for your situation to fill an allocation from fixed income or bonds if they're appropriate for you. They may not be. But if they are, we do believe in 2025, the bond market has as many risks as they have opportunities. Because, quite simply put, there is a lot of volatility due to the geopolitical risks, the uncertainty with the Fed, and this makes the case, in our opinion, for active management and for hiring a fiduciary. Reach out to us at crestmontpw.com if you'd like to continue this conversation. If you would like a review of your portfolio, whether it's fixed income and bond holdings, or your total portfolio, or your financial situation, just your life situation, reach out to us. We're a friendly bunch. We have offices in Houston and in Boerne, Texas. I'm the CEO and owner of Crestmont. We'd love to hear from you. You can reach us at info@crestmontpw.com or look us up on the web, crestmontpw.com. I hope you've enjoyed today's show. God bless.